Hello everyone, so welcome to the series, long anticipated, and apologies it took a while to come out. And alright, so in this series we're going to be talking about time. We're going to be talking about time and sessions. So the secret of time is a very long, delicate topic. Let's be very frank and honest, and I cannot find a way to do it, complete every single thing in this one video. So we're going to have a series for it, right? So in this particular series we're going to be looking at the time-based model, and we're going to be starting with 159, the popular one, the popular time-based model, which you all know, 159. And I'm also going to show you the misconception around it, right? 159. And I'm also going to show you the misconception around it, because there is misconceptions around it, you know. So and after that, yeah, we'll call it a day. Then progressively we're going to talk about the 369, the purge times, and what set intersection liquidities. Now all these things are very important if you're going to become very detailed when trading the market. Is actually a very beautiful thing to become a very detailed trader. You have a lot of traders that are very patternic in nature, so they are clicking by clicking sell because they are pattern formed. Yeah, so you eventually, for the smart money traders, I mean to say the SMC trader, you have they usually have something like this, you know. So this is their inducement liquidity, and this is what their POI. Now wherever they see this thing, the concept work is beautiful concept and it works, but I just want to give you a glimpse into how we have so patterned everything. And for every single time you pattern something, listen, because it's a pattern, the market will oftentimes give you a few pips. It will deliver pips to you to always do what? Keep you in track, or rather keep you in check that okay, my stuff work. Maybe it's just a little hitchy glitchy, or find a way to blame the market, as the case may be. So you have been taught specifically as what? An SMC trader, that's a smart money concept trader. When you see this kind of pattern, you do what? You expect what? A smash into your POI, and you expect a sell. But in some scenarios that doesn't happen. You just say a smash and boom, bro just triggers you and continue moving on. Now, does pattern work? Pattern work, but pattern best work when there's what? Time supporting it. There is time price moves, yes. There are micro times and there are macro times. There are times what? When you see specific pattern, if the time is right, it will play out. But if the time is wrong, it's going to fail. So in this series, we're going to just be looking at the 159 trading model, right? So it's going to be very brief, and I'm going to be straight to the point. So the first misconception we have had around trading 159. Meanwhile, I hope the previous video was very insightful. I spoke about key level, I spoke about a whole lot of stuff. They're very important, and I know you might not see the value of it now, but trust me, when you put it to much practice, you're going to see the value of it. I've had a few messages of people telling me how insightful those videos were. Some of them have gone ahead to pass their accounts, pass their challenges, with just the little information dropped on that video right there. So I hope you really find that very insightful, and take time to watch it over and over again until it sinks right there. There's no time to say it's enough. All right, so the 159 base trading model, the first thing you need to understand is this: there is no pattern to 159, and I'm going to explain that. There is no way it's advisable for you, what, as a trader, CRT trader per se, to pattern what? 159. You're going to be ridiculously what? Wrong every single time. You don't pattern it, what? You logic it. Now what do you mean you logic it? You people keep saying stuff about logic. You keep saying don't trade the pattern, trade the logic. Oh, how do you trade the logic? Blah blah. Now let me explain that. When they say you should trade something logically, they mean you should abolish every context that triggers you to pattern this stuff. And how do you pattern this stuff? Is because, listen, have you come across YouTube video where they tell you, okay, this is the 9 a.m. trading model? You literally do what? Yeah, I've come across that video. You literally do what? You come here, you have a single 9 a.m. candle, right? The highs, the low, right? You have the high or the low, and they tell you, okay, wait for the next candle, which is the 5 a.m. or rather 1 p.m. You wait for it to do what? Sweep the low, close above, then you do what? Wait for the next candle to distribute all the way. So you have 9, you have 1, and you have 5. So because according to some concepts, or according to some videos, or according to your what research and your study and whatever and what have you, you now pattern that, okay, 9 a.m. candle are often a manipulation candle. So you stick to that concept, you stick to that pattern, and you keep getting wrecked every single time, because you have patterned that 9 a.m. should be what? An accumulation candle. You expect what? 1 to do what? Either sweep the low or sweep the high. If it closes below, good and fine. Then you expect 5 to do what? Distribute to the what? Opposing end of the liquidity of the candle range. Now when you stick with this thing, every single few times it's not going to work, is because you patterned it. Now let me show you how to, like I said, I'm going to correct the misconception around it. So I'm going to show you how to do it more logically. How you do it more logically is this. You need to first understand that any of this candle, whether the 1 a.m., 5 a.m., 9 a.m. or p.m., whatever have you, can be what? Can be candle number 1. That's the first thing you need to understand. Any of these candle can be candle number 1. 1 a.m. most times can be your candle number 1. 5 a.m. most times can be your candle number 1. 9 a.m. most times can be your candle number 1 for Asian. And for what? Daylight, 1 p.m., 5 p.m. and what? 9 p.m. All these can be your what? Candle number 1. There is no law. You don't, this is how you are patterning it. You are telling yourself that, okay, every single 9 a.m. candle should be candle number 1, and you're going to get destroyed for that. That's what you're telling yourself. Every single what? 9 a.m. candle, because you watch a 9 a.m. trading model, should be candle number 1. Now these are the keynotes these people leave outside the context of these videos that you watch on YouTube. YouTube is a great facility to learn. So these are the content keynotes that people leave outside of it. Then you go to your chart and eventually it doesn't work. You become so unfortunate and it doesn't work. Then the next thing you go about ranting on people's CS section, that's their comment section. Oh, fraud, oh this, oh that. Do you understand? And you keep getting wrecked and you blame the system. In this video, I hope to bring you a bit more little enlightenment, because if you understand this little concept, you're going to wreck the market. Listen, one full 4 hours candle is enough to make you profitable. This is how beautiful it is. Do you know what one full 4 hours candle contain? It can literally contain 40 pips. It can contain 30 pips. It can contain 25 pips. And that is enough to do what? To give you daily bread for the day. So imagine you are catching a single what? H4 candle every single day. Probably, because he's going to print every single day. Now what you do is do what? Filter the low probability from what? The high probability. When you filter them, then you do what? You make your choices and what? Set your priorities right in according to what? Risk management and what? Your risk appetite. So having said that, let me show you how to do what? Trade this model logically. Pay attention to what I'm going to do right now. This is your 9 a.m. candle, right? And you have, pay attention please, that's your 9 a.m. candle, and you have your 5 a.m. candle coming forth like this, closing right what? Above the high. Does it make it invalid? No. Remember the previous video, I told you, I said narrative matters, bias matters. You need to build your context. You need to tell your story. You need to be able to tell the story of the pair from a higher time frame down to a lower time frame, down to your entry and your exit. So narrative matters a lot. Now, when you are trading the 159 time logic model, this is what you do based on what you have watched on YouTube. When you see something like this happen, this setup becomes invalid to you. Why? Because according to what you were told, you need to wait for a sweep. You need to wait for what? Candle 2 to do a sweep. And if it doesn't do a sweep, you abolish it. And that's because you are patterning it. Now, if the narrative of this particular structure is bullish, this is not invalid. This model is not what? Invalid if the narrative is bullish. Why? Because it's simple. It closed higher. All you need to do what? Expect a little pullback and continue all the way to the upside. This is how you logically trade it. Now I'm going to show you the second example before we enter a real life chart scenario. Number 2 is this. Like I said, 9 a.m. or 9 p.m., whatever as the case may be, is not, or rather must not be candle 1. It must not be what? Candle 1. Your 9 a.m. or your 9 p.m. is not what? A must to be candle. Why? Because it can switch depending on what, how the algorithm is doing what? Processing price delivery into the what? Drawing liquidity. So it can switch. Don't pattern it. Don't say 9 a.m. must be candle 1. Don't abolish that concept. It's a very, very irritating concept. 9 a.m., 9 p.m. must not be candle 1. These are New York Times, right? It must not be what? Candle 1. It must not be candle 1. Sometimes it can be what? 5 a.m. can be what? 1 a.m. Right? So you need to do what? Know when to interchange it. You need to know when to leave the logic factor and focus on it. Then number 2 is this. You need to know the session you are trading. You need to know the session you are trading and the session that what affects the pairs you are trading. For example, let's say you are trading Asian related pairs. Do you understand? You are trading Asian related pairs. You need to pay attention to what? To Asian session a lot, right? If you are trading Asian related pairs, you need to pay attention to what? Asian session. If you are trading US related pairs, you need to pay attention to what? New York session. If you are trading pounds related pairs, you need to pay attention to what? London, right? So you need to know the sessions you are trading, and you need to know the pairs you are trading and what the sessions that impact it the most. These are key factors that you pay attention to when we're talking about time. Do you understand? Does this mean that, okay, if I'm trading a US dollar related pair in Asian session, does it mean my setup will not work out? No, it will work out, but the probability of it working out becomes low. Why? Because that is not the session that what impacts that pair. So the probability it lessens. To be on the safe side and always what? Stay on the safe side. You need to stick to the pairs you are trading and also stick to the sessions that affects this pair the most. So because for me, for example, now I trade GBPUSD a whole lot. I trade GBPUSD a whole lot. So what am I doing? I'm paying attention to what? To London session. I'm always paying attention what? To the London session. So my main focus, my main target is what? Is usually the 5 a.m. because I'm basically a 4-hour CRT trader, right? The 5 a.m. candle, the 9 a.m. candle, down to what? The 1 p.m. candle. This is where my trading session ends, the 1 p.m. Why? Because this core session, this New York session, of course New York session does impact it, but these are the basic time I want to pay attention to if I'm trading what? London related pairs, or rather sorry, pounds related what? Pairs. So I've established 2 things right about here. The first one I've established is this. I established that don't pattern what? 159. Don't pattern it. Don't pattern 159. 159. Yeah. Why? Because I said 1 can be candle 1, 5 can be candle 1, 9 can be candle 1, depending on where, the context, the narrative, how, and also depending on how price is doing what? Running to meet the drawing liquidity, right? This is why SMTs are important. I'm going to talk about SMT towards the preceding class. It's very, very important. SMT is classic. Any person that downplays the rules of SMT is a dumb trader. Yeah, it's a big time dumb trader. They are important and they are classic. Number one, I say don't pattern 159. Don't pattern the 9 a.m. trading model, 5 a.m. trading model, 1 a.m. Don't pattern it. Don't stick to one particular timing and say, okay, time-based model and say, okay, this is the one I'm expecting as candle 1 and this is the one I'm expecting as candle 2. No, don't pattern. Then number 2, I said something. You need to know what the sessions you are trading and what the pairs, right? So you need to know the pairs you are trading and the sessions that does what, that does affect it very, very much. Now, enough of the whole gibberish and all of that. Let's look into practical, right? Let's look into practical. So this is EURUSD daily time frame. What's the narrative? We're running to do what? Hit a drawing liquidity at the high right there. So I'm scaling down to the 4 hours time frame. Why am I scaling down to 4 hours time frame? It's simple. 159 AM or AMs, whatever. Then you have PMs. These are 6 candles in general. So these 6 candles do what? Makes up what? A 24 hours candle, a single daily candle. So you need 4 hours, 6 candle to make up a 24 hours daily candle. Simple. When you build this is so simple, for God's sake. When you now come to the daily time frame, build your narrative and you build your what? Daily bias. Let's use this for example. So let's forward test. Let's not back test. So this Wednesday's candle today, right? And there's a whole lot of SMT between EU and G right there, but let's not focus on that. Let's just focus on this. So this Wednesday's candle right about you, and this is the high. The highs and the lows are always your guide. Always, the highs and lows are always your guide, just like Romeo said. So this is the high, and this is what the low, right? Now, so that's the high and that's the low. You have built your what? Your daily bias. We're expecting that what? Price keep rallying because there's what? An external drawing liquidity somewhere here. Yeah, so we have a drawing liquidity somewhere there. So we expect that price does what? Keep rallying all the way until what? That drawing liquidity is met. Now scaling down to 4 hours time frame, we now implement the sequence of trading these time-based models. How? It's very simple. It's very simple. So this you have, let me make this a bit big for your optical eyes. I don't really like it big, but let's just make it big. So this you have right here. This is the last 9 p.m. candle for what? For Wednesday. That was yesterday. This is the last 9 p.m. candle for Wednesday. And these are the highs and this is the low. This is how it's done, brothers. Listen. This is the high right here. And this is the low. That's the high and that's the low. What are you waiting for? What are you now looking for? Because the narrative is to the upside, we want to see smart money do this thing. These are basic way of, we want to see smart money doing what? To sweeping the lows, right? So I want to see these time-based entry models sweeping low to distribute to the up or close above to retest and continue. It's as simple as these are the 2 things I'm looking for. Depending on the narrative you are trading this time-based model, you want to be looking out for these things. The lows being taught to soup to deliver into a higher drawing liquidity, right? Or the highs being taught to soup to deliver into a drawing liquidity at the lower region, right? So seeing that, okay, the day has started, depending on the kind of what trader you are and depending on the kind of pair you are trading now, and depending on the session also you're going to be paying attention to. Now let's say, okay, I don't really, this Euro years, I want to be paying attention to London and New York session more than what Asian session. Right, I want to be paying attention to London, New York more than what Asian session. So this is what this PM. This is 1 a.m. This is literally Asian session. So I'm not going to be paying attention to this. This is not what I want to be paying attention to, right? This 9 p.m. right? So this is 9 p.m. Wednesday. This is a new day, right? So this is 1 a.m. Now 9 p.m. of what yesterday did what? It closed above. This is the huge closure above. So what do I want to do as it closed above? I want to look for higher price. I want to look for entries to do what? To get higher price, to join the buys, right, until the drawing liquidity is met. I don't really like this example right here, but I think we can manage it. So it closed above. We're looking for what's higher price. Then here you have the 5 a.m. Now we're entering into the session that now matters. We are coming into the session that matters. This is the 5 a.m. right here, right? And this is how the 5 a.m. closed. Every single thing closed way above yesterday. It closed above this 9 p.m. candle of yesterday, and this 1 a.m. closed very, very bullish, strongly indicating there's more potential buyers, willing to drive price in a haste to meet the target. Then you have 5 a.m. around here, and this is the closure of 5 a.m. right about here. And it was 9 a.m. 9 a.m. closed it above. All you are looking to do is to trade the time-based model, your 159, in sequence to the direction of the drawing liquidity. While doing that, you are not patterning this. So if 1 a.m. becomes the accumulation, fine. If 5 a.m. becomes the accumulation, fine. If 9 a.m. becomes the accumulation, fine. Right? But this is the hint. When you are trading it, or whatever pair you choose to trade, right? Any pair you are trading, or whatever pair you choose to trade, make sure that you are trading that pair with this time-based model in sequence to the session that gives volatility to that pair. So I want to be very, very active during London session and New York session while I'm trading GBPUSD. Why don't I want to really be active on Asian session? Because I don't really expect a lot of moves on Asian session on the pounds. Will there be move? Of course there will be move. Will I miss some opportunity there? Of course I will do. But I prefer to do stick to a time that gives meaning and volatility to these particular pairs that I'm trading at the moment. Does this make sense? Now let's look at the example. Remember, I said you build your narrative. Before I proceed, I said something very important. I said number one, you do you don't pattern it. You don't pattern the 159. Then number two, you do pairs and session. The pair and the session that does gives volatility to it, right? So let's look at this GBPUSD as an example. This video is already too long, so I'm just going to give the example, and that will be the end of it. Yeah. So right here you have this today. This is the price action of today. From here. From this particular region right about here into, that's from Wednesday ending, the end of Wednesday, right, down into Thursday. This is the price action. So all I needed to do was this: wake up. This is 9 a.m. candle model, sorry, 9 p.m. rather, right? Mark out the lows. Where is the low? This is the low. And mark out the high, and trade it in sequence to the higher time frame narrative. What's the higher time frame narrative of GBPUSD? We are buying aggressively. We are in a haste to meet up into this target. There's a daily target. We're in a haste to meet up to fill all these voids of liquidity resting around here. So we're in a haste to do that, right? So what do I want to do? I want to see the next candle, which is 1 a.m. sweep the low, right? Remember, to sweep the low, deliver into the high. I want to see you sweep the low and do close above or deliver into the high. Right about here, that's exactly what he did. He swept the low and delivered into the high. If you go lower time frame, you're going to see an entry model here. He swept, I'm just trying to show you an example. So he swept the low and did what? Delivered into the high. So because he delivered into the high, he closed above what? The previous candle one, which is what? The 9 p.m. So what do you expect from candle 3? A continuation. How do you get this continuation? This is a breaker. You come to your lower time frame. I took this particular trade, right? Come to your lower time frame and do what? Execute your entry and do what? Continue all your way to the upside. It's as simple as that. That's how easy it's been done. In other sequence, it's not going to be 9 p.m. like you saw here, right? It might be 5 p.m. It might be, but all that matters is this: pay attention to what? How the pair rather is delivering into what? The overall flow in liquidity, where you build your narrative, maybe build your daily bias using the highs and the low. Obviously the highs and the low are always your guide, so you do what? Pay attention to how it's delivering, or where it's running to, or where smart money are doing what? Trying to push price into. Then you do what? Sit on this time-based model, right? And do what? Trade it all the way until you hit your target. What's one thing that's important when you're trading time-based model is what? Key level. Key level is very, very important when you are trading in your what? Time-based model. Key level is very, very important when you're trading your time-based model. And if you don't know what key level is by now, watch the previous video. You're going to get the details of what key level actually looks like. So that's it, guys. See you on the next scene. Yeah, subscribe if you wish.